pace at which the UK economy will emerge from lockdown is by no means certain after the latest government pronouncement, and investors with exposure to UK equities will get a first chance to see if consumer sentiment's being affected on Friday the 25th of June, with the latest release of consultant GfK's Consumer Confidence Indicator. The last reading was -15 for April, a 1-point improvement on March and the 5th straight gain. It was also some way above the low of -34 that was plumbed in April and May of 2020 during the first lockdown. Given that service industries represent around 4/5 of the UK GDP and household consumption around 60%, the economy is heavily reliant upon consumers feeling confident enough and being affluent enough to spend, or at least borrow. We've seen retail sales start to recover with the reopening of non-essential physical shops on 12th of April. April showed a 9.2% month-on-month increase in volumes and a 42% surge year-on-year. So let's see if consumers are still feeling confident enough to splash a bit of cash. Politicians and economists alike will certainly be hoping so. The consumer will also be the main feature of the macroeconomic data that are due in the USA in the coming week, with the release of the Personal Consumption Expenditure data, or PCE data, also on Friday the 25th of June. Now, this is one of the Federal Reserve's preferred indicators of economic health, and, remarkably, PCE reached a new monthly record high of $15.6 trillion in April on a seasonally adjusted annual rate basis. That represented a year-on-year increase of 29%, not really what you'd expect when a pandemic's still on and unemployment is still elevated, even allowing for the base effect. Stimulus checks must be helping here, so it'll be interesting to see what happens as the US government eases off on the so-called stimmy, although unemployment in America is coming down and wages are going up. Back on the home front, we have a select list of corporations that are scheduled to release results, host a meeting for investors and analysts, or hold their virtual annual general meeting. Names which may be worthy of further research include the following: retailer Gear 4 Music on Tuesday the 22nd of June, house builders Barclay and Crest Nicholson, as well as GlaxoSmithKline on Wednesday the 23rd. Then we have Wood Group and the second day of a GlaxoSmithKline analysts meeting on Thursday the 24th. And then Tesco's annual general meeting rounds off the week on Friday the 25th of June. But the stock which could just cause the biggest fuss in the week ahead, even allowing for how GlaxoSmithKline is likely to outline its defence against the activist investor Elliott, well, that's DS Smith. The packaging giant and FTSE 100 constituent is due to release its full year results for the 12 months to the end of April on Tuesday the 22nd of June. The shares are trading at the highest level since autumn 2018. DS Smith has been a pandemic winner, if anybody can be truly said to be a winner under such circumstances, thanks to the boom in online shopping that's been further stoked by lockdowns. Behind that remains a solid business based on supplying packaging to fast-moving consumer goods companies. Now, this is all quite a change in perspective from a year ago when DS Smith reported its last set of full-year figures. Then, the company cancelled its dividend, flagged a £15 million hit from COVID-19 costs in the final 2 months of its financial year, and warned of lower volumes and higher costs for the year to April 2021. However, trading statements in September and November were more upbeat, and the company declared an interim dividend in December. A further trading update from Chief Executive Miles Roberts in April also read well, as the boss stated that results would meet analysts' expectations, thanks to higher sales volumes, some price increases, and improved performance in the USA. Now, the first figure that analysts will study is pre-tax profit. On a stated basis, the analyst consensus is £237 million against £368 million a year ago, although that's not strictly a like-for-like comparison, owing to DS Smith's disposal of its plastics business. The number crunchers will then dig behind the headlines and look for commentary on trends in volumes, input costs and pricing, especially as inflation is the source of much debate across financial markets more broadly right now. Just as important will be any steer on the profits outlook for the year to April 2022, when analysts are looking for a rebound in pre-tax profit to £354 million on a stated basis, almost back to where they were in 2019 and 2020 before the pandemic. Attention will then switch to the dividend. DS Smith declared an interim dividend of 4p a share, and for the whole of this financial year, the consensus analyst forecast is looking for a payment of 12.5p a share. Analysts are then looking for a further increase to 15p in fiscal 2022. Given the still uncertain operating backdrop, DS Smith is unlikely to be held too closely to account on its long-term financial goals, although analysts will doubtless check that management still feels they're ultimately attainable. These are organic volume growth of at least GDP growth plus 1%, an adjusted operating margin of 10 to 12%, free cash conversion of more than 100%, and reducing net debt to below 2 times earnings before interest, tax, depreciation and amortisation, or EBITDA. Net debt ended the last financial year in April at £2.1 billion, including leases and pension liabilities, although the good news was then that the firm had no major debt repayments or refinancings due till 2023. That suggests that time is very much on the company's side. I hope that you and your families are all in good health and good spirits. Thank you for listening, and I look forward to talking to you again next week.